Hi everyone, this is Eric from Traders Helping Traders with this week's Tricks of the Trade. I know a lot of you are not really interested in trading indicators, and that's probably because you've been let down by trading indicators in the past. Let's face it, indicators are always lagging. With very few exceptions, the signals are always coming after the price action. But let me show you a little something that might restore your faith in using indicators. Now, as a support and resistance trader, I don't usually trade the indicator on its own. However, I don't mind using an indicator as a confirmation signal, or something to help my timing, or something to help me get on the right side of the trade. Now, the indicator that you use is not as important as the way you use it. You can use any of the most popular indicators like RSI, stochastics, MACD, and make them a lot more effective by just doing a couple of things to them. Let's take a look at this example here in May corn using a standard RSI. Now, the standard setting for RSI is 14 periods. The overbought, oversold regions with RSI are usually 60% and 40%. Like a lot of indicators, RSI is measured on a percentage scale, and the higher the market gets, or the more overbought it gets, the closer the indicator is going to get to 100%, and then the lower or more oversold it gets, the closer the indicator is going to get to 0. This is true for RSI, stochastics. CCI is slightly different. It ranges on a scale from plus 200 to minus 200, but the principle is the same. MACD is overbought and oversold in a slightly different way, but the MACD indicator is used more to measure momentum and shifts in momentum. However, it's plotted on a zero scale where the zero line is the halfway, and essentially anything above the zero line is bullish, anything below the zero line is bearish. Alright, enough of that. How do we tweak these indicators so that they become more effective for us? Well, the first thing I usually do is I cut the standard setting pretty much in half. That will make the indicator infinitely more responsive. Remember, there's a lot of traders out there using the standard settings, and by cutting it in half, we're going to make ourselves that much faster than the typical trader. So with RSI, we'll change that from a period of 14 to a period of 7. And all of a sudden, you can see that our RSI has become a lot more erratic, or so it would seem. Now, the key, or the second part of the key to using an indicator effectively is that you need to use it with trend. A lot of these indicators like RSI, stochastics, MACD, CCI, all the real big ones, they're all oscillating indicators. And what that means is they go high, they go low, they go high, they go low, they go high, they go low, just like a seesaw. And this is where a lot of people learn to hate indicators. They say, well, it doesn't really give me a good sell signal. It gives me a sell signal, and then the market only moves a couple of ticks before it takes off again. Yes, but where does it take off? It usually takes off with the trend. So let's take a look at RSI with the period cut to 7 and not doing anything different, but just trading the traditional RSI 60% and 40% overbought, oversold regions. Let's take a look at how this indicator would work. I have a 55 period moving average on here. You can use any moving average line you like. I find 55 pretty good. Some people might like 60. You might like 20, although for this particular purpose, I might find 20 a little bit too fast. You might like 100 or 120. Anything over 120, at least for the commodity markets, on a day scale, might be a little bit slow. But if you choose something around 50, 55, 60, 100, 120, something to determine your trend, you'll probably be doing all right. Now, the way RSI is traditionally traded is when the market is overbought and it crosses below the 60% line, that's a sell signal. And when it's oversold and crosses above the 40% line, well, that's a buy signal. But what we're going to do is we're only going to use the indicator in conjunction with the trend. Therefore, the trend, so long as the market is above the trend line, we're going to only be looking for buy signals. So we're going to ignore all these sell signals that come up. Now you can see that there is the odd occasion where the market actually responded well to a sell signal and moved a little bit in the right direction, but overall the sell signals were very short-lived. Now let's take a look at what would happen if we just followed the buy signals. Well, we have a buy signal back here. Well, actually, let's go way back here. We'll go back to the first one. This is our first buy signal here. It came just as the market bounced off of the 55 moving average line, and look at what a nice move ensued as a result. The market came back down. Here's our next buy signal right here. Okay, well, that one, it's right there. There's our next buy signal right here, and you can see that we had some pretty nice gains off of that. The market flattened out a little bit, came back down. Our next buy signal came in right about here. And even though the market stalemated for a few days, we got still another nice rally. Where's our next buy signal? Our next buy signal is right here. And you can see that this one actually came a couple of days before the actual move, or the larger part of the move. And once again, the market took off. And then lastly in this chart, we have a buy signal right here. And from here, the market has advanced at least for the last week. So that's a pretty good run, actually. By shortening the length of the indicator and trading only the trend signals, not doing anything else different, we would have actually had 3 or 4 very good winning trades. So next time you take a look at possibly incorporating an indicator into your trading system, consider shortening the trading period of the indicator and putting a moving average line onto your chart and only trading with the trend. I think you'd be pretty happy with the overall results. And that's this week's Tricks of the Trade.